All right, so today we're going to build out like I said, the valuation model of Coca-Cola using data from Bloomberg. So I posted, as I said, to Canvas in the file section, a file called Valuation Model KO Start. And it is slightly different than the file that we had started working on last week. So you will all need to download that file, and that will be our starting file. And specifically, what's different about this file is it has 6 years of historical data, where last week we'd actually just built one with 5 years of historical data. Now, the reason why we have 6 years of historical data has to do with CFI. With 5 years of historical data, how many CFIs can we do? 4. I want to have 5 years, so therefore I had to add an extra year. So basically, that's why we're going to use this model. So it has an extra year of data so that we can do the analysis for 5 years. Now, the way it's set up, again, we'd started to do this last week, is we have 3 tabs: Data IS, Data BS, and Data CF for cash flow, which is basically the exported income statement, balance sheet, cash flow data from Bloomberg. Those are the first 3 tabs in the model. Then we have a tab called Income, where I have essentially recreated the historical data to make sure it fits. And this is the tab where we're going to basically put the forecast data next to the historical data. So part of what we're going to do is we're going to forecast out financial statements. So the Income tab, recreating the raw imported data, is where we're going to do it. Just kind of cleaned it up a little bit, put it on that tab. Same thing with the balance tab. These are the historical balance sheets. These are the ones that we are going to start forecasting. So just recreated what was in the raw data that was exported from Bloomberg. Okay. Then, as we had talked about last week, I have historically done for you a change in equity tab, mainly to deal with the AOCI adjustments that are here. Right? And 2008 doesn't matter because I don't have a 2007 equity number. That's why there's a reference missing, because it's always looking for the starting number for the previous year, but it doesn't really matter. But nonetheless, these are going to be the other adjustments to equity in the other years that we're going to need on our cash flow statement. And we only need 5 years worth of cash flow. So therefore, it gives us the historical AOCI adjustments to get our CFI to balance. All right, we won't need that in the future because we're not making adjustments to equity in our model. Okay, so we only need it just for the past to get our CFI to balance. But I've done that for you. Then I have converted what we did last week correctly, hopefully, the TFIs, the TIIs, and CFIs, and the economic profits. Now, there's 2 economic profit tabs here. We have been doing, and on the midterm you will continue to do, what's known as a beginning of year economic profit. Right? And the reason you're going to do that, you're going to see that when we do the valuations, is that will allow our DCF and economic profit valuation to balance. But we're also going to list an end of year economic profit as well. So it's a second tab. EOY stands for end of year, and we're going to do that for analytical purposes. Right? And then I also added what we're going to call the ROIC tree. Right? And basically, this is the other part of the historical analysis that we're going to do in addition to the CFI. So I'll just quickly talk to you about the ROIC tree since we're here before we move on. So you'll notice that the ROIC tree is based on EOY ROIC, right? End of year ROIC as opposed to BOY ROIC. So again, on your midterm exam, on your homework assignments, you're going to calculate ROIC using the beginning of year data, beginning of year economic profit. But for example, when we do analysis in this ROIC tree, we'll use the end of year data. Okay? So here's the whole point of the tree. What the tree does is it helps us really understand the ROIC drivers of a company. And in this case, we'll start out with end of year ROIC. And what I'll say is there are 3 things that will always affect ROIC. All right. Number one, tax rate. Okay. So what we're going to do is we're going to look at the year-by-year tax rate the company's paying, and then we're going to strip it out, and then we're going to look at the pre-tax ROIC. All right. So we start with after-tax ROIC, and then we look at the pre-tax ROIC, which is the actual performance of the business regarding tax without the impact of taxes. And these numbers right here under the table are percentage change from 5 years ago. So part of what I'm also going to ask you to do is look at like a 5-year trend. So I just want to know it's not your percent change for 1 year, but over a 5-year period, what's been happening. So here's what we can say for Coca-Cola. Their tax rate is 9% higher in 2013 than it was in 2009. And it used to be 22.8, now it's 24.8. Did that help or hurt their ROIC? It's now hurting their ROIC because they're paying more taxes now than they were before. All right? So their ROIC overall went from 40 to 26. So that's what I want to do. I want to understand why over 5 years their after-tax ROIC went down. Taxes, we just said, hurt the ROIC. Are taxes the primary reason their ROIC went down? Because their ROIC went down by almost 35%. Taxes the primary reason? No. Did taxes matter? Yes. All right? So that's what we need to start to understand. But the primary reason was the decline in pre-tax ROIC of 33%. So Coke's real challenge is not the taxes they're paying. Coke's challenge is they're actually making absolutely lower returns. All right? So number 2 and 3. 2 and 3 drive those returns. Remember, margin times cycle time equals ROIC. So we have our operating margin and we have our cycle time, just not multiplied by 365. So margin times productivity or efficiency equals ROIC. So these two things, here and here, have equal weight in determining the pre-tax ROIC. So what happened to Coke's operating margin over those 5-year period? Down. So did that help or hurt the ROIC? So you could say that operating margin really hurt the ROIC. Went down by 17.8%, where they were making 26.6 cents operating margin. Now they're only making 21.8 cents. So they're making absolutely less money when they sell their products. What about productivity? Invested capital divided by sales. Are they more or less productive today? They're less productive. So did that help or hurt their ROIC? It hurt their ROIC because now they're spending 62.7 cents per every dollar on invested capital, where before they were spending 51 cents. So they hurt their productivity by 23%. So if you really think about it, it was a combination of lower margins and less productivity that almost an equal weight really hurt their pre-tax ROIC, and they're paying higher taxes. All three factors are working against them. Okay? This is what I'll call the first level of analysis. Those three things for any company will explain to you what's going on with their ROIC. What's happening to the taxes, what's happening to their margin, what's happening to their productivity. We have to explain it, and just like I told you in the CFI analysis, you have to be specific when you're explaining it. Refer to actual numbers. You can't just tell me ROIC is going down. Which ROIC are you referring to? Pre-tax, after-tax. Are you referring to it over a 5-year period or referring to it over a 1-year period? Therefore, ROIC went from 40.2 to 26.2. And the reason why is because the pre-tax went from 52 to 34.8. Be specific when you give me your answers. Okay? All right. Going step further, we then have what I'll call the second level of analysis. Second level of analysis is explain the operating margin, explain the productivity. To explain the operating margin, we go to the income statement. There are three things off the income statement that matter. Gross margin, which is the gross profit divided by revenue. Operating expenses, which are called selling, general, administrative expenses. And non-cash expenses, depreciation, amortization. So here's the point. Gross margin minus SG&A minus depreciation equals operating margin. So these three things determine the operating margin. So, gross margin. That's giving us a sense of the difference between the price and the cost, essentially the markup. What's happening to the gross margin of Coke or their pricing power relative to the cost of goods over the 5 years? It's decreased by 4.8%. Is that helping or hurting their operating margin? It's hurting. What's happening to their SG&A? What's happening to their depreciation? But did the depreciation, even though it went up the highest percentage, did that really hurt them? Not really. So what really hurt them? It was the gross margin and the SG&A. But you're seeing really a compression of the two. They're making less on every sale and they're spending more to sell it. Okay? That's just the nature of that more competitiveness that they're starting to feel out there in the marketplace. Right? And we're seeing it as a 5-year trend. So that's what's explaining the operating margin falling down. What about productivity? Invested capital to sales. Now we go look at the balance sheet. 3 things drive operating invested capital. OpWC is working capital plus net PP&E or net fixed assets plus investments in intangibles and goodwill. This plus this plus this equals invested capital to sales. You can sum them up. So these are the 3 drivers of productivity off the balance sheet. Right? What's happening that's causing their productivity to get worse? Is it working capital? I'm sorry? No, they're actually getting better with their working capital. Is it PP&E to sales? Is PP&E to sales getting better or worse? It's getting worse, but it's not the primary reason. But they are getting a little inefficient on their facilities. What's the primary reason? They did some acquisitions, particularly in what year? Between 2009 and 2010. Somewhere in the 2010 range, they bought something pretty big. And specifically, that's when they started buying their bottlers. So Pepsi started the trend. Pepsi started buying its bottlers. Coke started buying its bottlers. So it was a huge acquisition. Bottlers have higher or lower margins than Coke. They have lower margin. So part of this could also be that they bought their bottlers, which meant they bought a lower mix of business, right? And again, you could say, well, why would they want to do that? Well, part of it was they wanted to have more control over the distribution because to some degree their bottlers were getting out of line. Their bottlers were starting to sell other people's products, particularly outside the U.S. And Coke didn't want that to happen. So Coke wanted more direct control over their distribution. Right? So basically, they started to buy their bottlers, just like Pepsi did. It was very, very critical for them to make sure that it was Coke and Coke alone, and that they had more control over their distribution. So anyways, long story short, this is what you see is happening. So when I tie it back together, what really mattered to the decline of the ROIC of Coca-Cola, it was a combination of the lower gross margin, the higher SG&A, and the spending on intangibles. Spending on acquisitions. That's really what drove down the ROIC. Right? Again, being specific about some of the numbers that we talked about. But that's the ROIC tree analysis that we're also going to have to do. In terms of your group projects, that's section 2. Section 2 of your group projects is the ROIC tree analysis and the CFI analysis. Right? And the reason why we're doing that is because before we forecast, we got to have a sense of the past. Matter of fact, our model creates for us the historical CFI. So if we were looking at Coke's CFI, now one thing that you'll see over here in column S is a total, and there's a whole bunch of blank spaces. It's not an error because all these blank spaces are eventually going to be the forecast that we're going to stick in here in the middle. Okay? But for purposes of doing analysis, well, once we stick it in there, I'm going to hide, don't delete, but hide these columns. And then I'll put that total next to it. So that basically this total sums the historical 5 years. Right? So that'll give us a sense of what's happening in the past of Coke based on their CFI. Okay, so we've converted the CFI, we've talked about what it tells us. We know we want to analyze the 4 sections. So we'll start out with the 5-year analysis for Coke. What can we say about operating and their free cash flow? Oh.
Well, you could say, like we discussed before, between 2009 and 2010, it's that negative free cash flow.
Yeah, 2010, the negative free cash flow. There's the acquisition. There's the big jump in goodwill. You can clearly see it in the CFI. Right? That negative free cash flow is when they bought their bottlers. Right? But despite the fact that they had negative free cash flow in 2010, they generated a lot of free cash flow over the 5 years. In fact, they generated almost $47 billion of gross cash flow. They only reinvested about $16 billion. They did spend $8 billion on goodwill premiums, but they still ended up with $21 billion of free cash flow after they did all of that. By the way, what is their overall reinvestment rate, including acquisitions? Here's somebody say 47%. So 46.9 is what? That's free cash flow as a percentage of sales. What do we say free cash flow theoretically represents? The payout rate. This is the theoretical payout rate. So what's the reinvestment rate? 53. 53.1. Now, what's the reinvestment rate without acquisitions? It's really 65. Because they're putting about a third of it back in, and they technically have about 65 to pay out. But after acquisitions, it includes 47. It was interesting. I was yesterday as part of the Bloomberg conference. It was mostly deans and finance faculty and finance department chairs, because that's Bloomberg's target audience in New York. And I was actually talking to a couple of the finance professors because I was showcasing what we do in this class. So I showed them the model and some of the screens that we do. We're talking about free cash flow, and they're like, we don't do it this way. And I was like, well, how do you do free cash flow? And he's like, well, what we do is we do gross cash flow minus gross investment, but gross investment is only CapEx and working capital. And I was like, well, I think that you should actually include acquisitions. And it was just interesting that a lot of people do not include acquisitions when they calculate free cash flow, something to be aware of. And that's actually not taught, and it was reaffirmed at most other schools. And this guy actually worked at a pretty good school. And he's like, well, why do you do that? And I was like, well, I gave him the argument. What is the argument? Why do we include acquisitions? One, they're in their forward projections, but conceptually, why are we including acquisitions? One, it doesn't go to investors, but what did we define free cash flow as? It's what's available, but it goes back to the concept of operating. Free cash flow is operating. If you buy a company and you run its assets, you're making an operating investment. And I'm just saying, he's like, oh, we didn't think about it that way. And it's not saying it's right or wrong. I'm saying that's the convention that's actually being taught out there, and that's something I just want you guys to be aware of, is that if somebody does it differently, it's not saying it's necessarily the wrong way to do it. It's just they've kind of taken a shortcut for convention purposes that, and again, you have to remember that modern finance, everything I'm teaching you today, started at the University of Chicago in the 1970s. That's the genesis of modern finance. And so basically, modern finance is only going on, 40, 50 years old? And what I'm telling you is that a lot of these conventions were created in the 70s and 80s. In fact, when I went to Wharton, my finance professor came from Chicago. And that's where Wharton was actually picking up all the stuff in the 80s. And they wrote the textbooks. And then those are the textbooks that we used. But here's the point. If you think about acquisitions, companies didn't do nearly as many acquisitions in the 70s and 80s as they do today. So when the first concept of free cash flow was created, nobody thought about talking about acquisitions as part of it. Or today, acquisitions are a cost of doing business. I mean, even Apple, which is not an acquisitive company, Tim Cook, in a argumentative way, basically was interviewed, and he's like, "Aren't you going to do acquisitions?" He's like, "We've done 15 acquisitions last year." And that's the point. They're relatively small ones, but increasingly they're just a cost of doing business for people. They're operating expenditures. But the textbooks don't say that because the textbooks really were written in the 70s and the 80s when we weren't doing acquisitions. So it's just something we have to be aware of as we go through the conceptual. Yeah.
I mean, I was just going to say, though, your gross cash flow includes the effect of it. So why wouldn't you?
That's what I said.
Yeah.
I'm just saying that's what we're doing. We're theoretically doing it here. But I'll go a step forward and I'll just show you, pick a company in Bloomberg, I don't know, Coke. And then you go to FA, which is financial analysis, and then you come down here and there's something called free cash flow. And then you can click on free cash flow and you can show the definition. And the definition of free cash flow is cash flow from operations minus capital expenditures. That's it. That's the Bloomberg definition of free cash flow. What are they missing? One, they're missing goodwill. They're also missing something else. Working capital. In the standardized definition that Wall Street uses, they're not even looking at the impacts of working capital. And we can see that if you look at a company like Coca-Cola, it didn't matter that much over a total, but it mattered a lot in the year 2013 because they actually freed up $2.7 billion of cash in 2013 by not investing or getting money out of working capital. And that's what I'm saying. Like, we have to understand that sometimes people take shortcuts, and we need to be aware of the shortcuts that they're taking. And that was just even a shortcut that they actually made in Bloomberg. So that was actually one of the comments I made to the Bloomberg people yesterday. I was like, fix your definitions. But, they don't care. Well, because I'm saying their audience is not us. Their audience is, Goldman Sachs and JP Morgan. And this is what Goldman Sachs and JP Morgan is relying on. So I'm just telling you, you go work on Wall Street, you might see some nuances in definition. And don't just go say, oh, you're wrong. It's probably not good for your careers. But at least you'll understand if they ask you to do something, why it might be different. Right?
It's not like you're more thorough than that.
This is a more thorough process. That's what we're trying to do. So that's what I'm saying. We're doing a pure Modigliani-Miller model. That's McKinsey's approach. That's actually why people like McKinsey, because they come in and they can say, look, we're being more thorough, where other people had taken shortcuts. And it's very intuitive when they explain it, why they're doing it this way. And that's why they get paid the big bucks. Okay? So essentially, that's what we're going to focus on here today. But nonetheless, back to this company generated $24 billion of free cash flow, all but 2010. Overall, with acquisitions and reinvestments, about a 53% reinvestment rate. What happened to Coke's non-operating items? How did 21 billion turn into 5 billion of CFI? They increased their excess cash by almost 15 billion. They increased their non-operating assets, but then they also had a non-operating gain to offset the increase in the operating assets. My guess is, when did most of this occur? Well, it kind of occurred, if you look at the non-operating gain, the year they did the acquisition. When did most of the increase in non-operating assets happened? The big increase was here. I have a feeling a lot of this had to do with acquisition accounting, if I had to guess. But again, we don't have the detail off of this statement, but the key point is they ended up chewing up about net $4 billion of CFI. Right? Tied up a bunch of cash, but they got some non-operating gains, non-operating income. So they had $5 billion to pay out. What'd they do with the money? What'd they do here in the debt section? They borrowed $28 billion worth of debt. Did they need to borrow $28 billion worth of debt? Did they need to fund their operations with that? No. Why? How do I know that? How do I know they didn't need to fund their operations? Because they generated free cash flow of $21 billion. And they had CFI even after non-operating activities of $5 billion. So I know they didn't need to borrow $21 billion. This was a change in cap structure. So they borrowed the debt, as somebody said, looking down a few, they paid out $21 billion worth of dividends. They didn't have $21 billion worth of dividends to pay. What's interesting is this number is very similar to that number. So pretty much they're paying out 100% of their free cash flow. Taking all that free cash flow, they're paying it out. So if you really think about it on a consistent conceptual basis, the payout rate of 53% is really a 53% payout rate. That's what they're paying out in dividends. But here's what they're doing. They're reshuffling it a little bit because they're borrowing all this money to also buy back more stock. Now, one could argue that that's just a cash return to shareholders. One could argue that that's also a taking advantage of low interest rates. But one could also argue that Coke is having some more financial challenges, which we saw in the ROIC tree, and Coke is trying to make sure their earnings per share look better by buying back a lot of stock. So they're getting growth in earnings per share because they're actually buying back their stock, and they have far fewer shares. It could be a combination of the three, but nonetheless, that's what Coke has been doing. So that's what we can see out of their CFI. Questions about that? Back to the model that we're building. So, there's a tab which is new, you didn't see last week, that I added this week. It's called ratios. So when you were doing the transformation of your model, most of these tabs were in there. This is the tab that's new. It's called ratios. And the idea of ratios is these are income statement and balance sheet ratios. So as I talked about the process in the book, as we talked about it last week in class, what we're going to do is we're going to create the ratios from the historical statements, and then we're going to forecast the ratios to forecast the statements. Right? So that's actually where we're about to start. Final tab in the model that I wanted to refer to is called assumptions. On the assumptions tab, they're just that. They're miscellaneous assumptions. And what we want to do is we want to have the assumptions in as few a place as possible as we build out this model. So that's why I'm putting them here. Okay. So
We're gonna add more assumptions.
that's right. That's why there's some blanks here. Right? And here's the step that I've done this morning that I've already done for you since we don't have the Bloomberg terminals in this particular classroom. You'd have to get it out there. But I'm going to show you what you're going to need to do. But again, I've already done this for Coke. So that's in Canvas, these 6 files. But basically, you're going to have to get these 6 files starting in the next week or so for your pharmaceutical company, following the exact same process that we're about to go through. Okay? So here's the thing. You go to your Bloomberg terminal, you get your account. Assuming you're logging in. In Bloomberg, the convention is this command line across the top. You either start typing in the company name, Coca-Cola, or you can type in their ticker symbol. It'll start to narrow down the functions, which are the 3- and 4-digit codes, of which yesterday Bloomberg said there are 18,000 of them since they started building the data service in 1979. And it was originally a DOS-based command line service, so the legacy of the software is still there. And so, as a matter of fact, they were asking, like, how many do people use in the room, like all the finance professionals that are academics, and the answer was like 30. So there's a whole, as I learned about all the job stuff that I showed you earlier about Bloomberg. A whole lot of stuff in here. But in any event, you type in company's name, narrows it down, ticker symbol, and then US means it's trading on the US exchange. And then if it was Australia, trading Australian exchange, London, etc. And then equity, which is equity, corp is debt. Okay? So in this case, we're going to be looking at the equity. So there's a whole fixed income side to Bloomberg. Then it'll give you this kind of summary menu of some of their short codes, which are either clickable or typable. So you can start typing the codes once you're on the company, or you can click on the code and it will get you data. Right? So the codes that we want to use, and we're going to focus on 6 of them, are first is FA for financial analysis. Right, so I either type FA or I click on FA. If I type FA across the top, or click on FA, hit enter or go on the keyboards they supply, and then it'll bring you to FA is financial analysis, which means historical data. So this is where they aggregate all the historical data for a company. So in this case, they use a series of tabs for the historical data. So it starts out with key statistics, income statement, balance sheet, cash flow, ratios, etc., all the way to custom. We're going to need IS, income statement. When you notice IS, the menu below is also contextual. It will then have a series of subtabs. Standardized, as reported, common size. Common size is percentage of total. Puts everything into percentages for you, kind of like our ratios tab, right? As reported, this is what came out of the 10K or 10Q. Standardized, this is where somebody at Bloomberg went through the 10K or 10Q and put it into a standardized format at Bloomberg. The income statement, and then down here at the bottom, keep scrolling, they have a reference item section, which is stuff coming from the footnotes. So this is above the data that's actually on the statement, below the footnote data, right? So that's very important because obviously there's more data than is just in the income statement itself. So we got to know some of that other data, and the key items are put here for us by statement, right? One word of warning is these reference items that are coming from the footnotes aren't consistent by company, because not every company reports the same information the same way in every footnote. So therefore, the reference items, even on the standardized statements, are not standardized, right? Whereas the income statement items above are mostly standardized. And that's what we're going to use. The idea is that they're mostly standardized to build a replicable model. But here's the next thing, is we're going to output this to Excel, dump it to Excel, but before we do, Bloomberg will allow you to slice and dice this data in many different ways. So your accounts need to be set up properly. So you click on settings to make sure that it's setting it up in a way that our model that we're creating is going to accept. So first, on the fundamentals tab of the settings, number of periods defaults to 10. We're going to change that to 6. I've already done that. So we only want 6 historical years, not 10 historical years. I don't need any extra miscellaneous data. I could, but we're only going to do 5 years of real analysis, so I want 6 years of historical data. Okay, so I'm going to limit at that. I want to make sure I'm doing annual data, and I want the most recent filing. I also want to make sure I have my as reported to be standardized, not the actual. Okay, so again, Bloomberg standardized template, because that's what we're going to be using. They've already put into this curated format. On the data tab, make sure that earnings estimates and current and last 12 months are not checked, because Bloomberg can also give you the earnings estimates as part of the export. So what it'll do is just add columns, and we don't want the columns to be added. We just want the historical data. So make sure these are unchecked. Same thing, we don't want the percentage or common size checked, and we don't want any growth rows. On the display, we want to make sure that it's in ascending order. By default, in your accounts, when you sign them up, it's going to be in descending order. Descending order means the most current year is on the left. Ascending order means the most current year will be on the right. Since we're going to forecast, we want the data on the right, not on the left. Okay? So again, we want to make sure we're in ascending order. And comma separated values. That's pretty default. So what you're primarily going to have to change, and then you can go to Excel, and then it defaults to table, but you can also export chart data. Don't export any chart data. We just want the raw data. So when you sign up for an account and you set up their default exporting settings, you won't really have to change this one. What you'll have to change is number of periods to 6. You'll have to change data to uncheck estimates and current last 12 months. And you'll have to come in here and switch it from descending to ascending order. Otherwise, when you export the data for your pharmaceutical companies, you're going to be doing a lot of cutting and pasting, right, to actually fill in the spreadsheet. Then hit update. It'll store that preference always for your individual account. Okay, so everybody will have their own unique account. When you change your preferences, it's your account preferences, not your team members, right? But then you'll see on the screen, I just have 6 years of data going from left to right. Right? By the way, just to show it to you, if I go back here to settings and I go to data, display, descending, update, notice 2013 is on the left. Right? I didn't want that, I'm just showing it to you. So I'm going to go back, settings, display, ascending, update. All right, so final step, I come up here to output, Excel. I dump it to Excel. So what will happen is, assuming Excel is loaded on the terminal, it'll open up Excel. It will always give me a security warning. Microsoft always gives you a security warning when you dump to Excel from Bloomberg. So you have to hit yes, otherwise everything will just stall. And the reason why there's a security warning, and you can kind of see it here, is that when it dumps out the income statement data, these aren't numbers. These are database lookups. So basically, Bloomberg sends Excel a template of database lookup codes. And then it pulls from the database over the internet, the so-called cloud, in real time. So essentially, the nice thing about this template is that if I set up a template, which I could actually set up just in Excel by exporting and moving around, that every time I open up this Excel template, as long as I had a Bloomberg terminal active, it could pull Bloomberg in real time and always refresh. And what would be nice is I could even come in here and change this from Coke to, I don't know, IBM, hit enter, and then basically it will refresh it with IBM's data because the database is based on the code in Bloomberg. So that's actually one of the nice features of Bloomberg, is that I can actually set up these auto refreshing templates or templates that can quickly change company data. But here's the problem. You have to have a Bloomberg terminal to do that, right? And you will not. So in this case, I'll go back to Coke. Yes. You have to be logged into Bloomberg, and you have to have a terminal on your machine. And you have to have the Excel file up. But that's actually the other point, though, is you could actually work in Excel, because in Excel there's something called a Bloomberg plugin, and you can actually look at this whole library. They have templates that you can use. You can, find fields, create fields in your database, and you can literally build these very complex, very specified models that auto-populate. And so that's the point. The valuation model that we're creating, we could actually make it so that all we literally have to do is type in a ticker symbol and everything else is done. But the problem is, each of you would have to have your own terminal, and that's just not financially practical. Now, if you work on Wall Street, it's a different story, right? But here, that's one of the limitations that we're going to have to deal with. So how we're going to deal with the limitation is that what you're going to do is, once you have this in Excel, to work on it on your laptop, once you leave the terminal, you will select the whole tab by clicking the upper left-hand corner. You will copy the whole tab. You will paste special values. And what that will do is that will overwrite all of the formulas with numbers. So now, if I save the spreadsheet and I leave the lab, I can leave with the numbers. If I don't do that, when I open up the spreadsheet on my laptop at home, I'm going to get garbage, because it's going to give me errors because it can't find the Bloomberg database. So this is a very important step, especially if you're using it here and you want to take it home. If you don't do this, you're going to be like, damn, I should have done this before I left. Okay? So back to this. Here's the other feature of Excel, is Excel chokes on these not available fields. So pound NA is Bloomberg's way of saying, I don't have data for this cell. So they dump the pound NAs. So the one other manual change we're going to have to do is get rid of the pound NAs. So we're going to just treat those as zeros. Right? So the simplest way to do it, I always do, is I just do a Control F, which is find. search for my pound n/a space n/a, hit replace, replace them with zeros, replace all. So that way, in my model doesn't die because I have a bunch of NA cells. Because it'll just say error in Excel whenever it tries to do a calculation based on that. All right, final step, file, save as. I need to save this as an Excel workbook. By default, it's a web page because it's sending out the macros basically to pull from the database. Shared, I'll put it on my download folder. Convention, I'm going to call this the KO-income statement. Hit save. All right, go back to the Bloomberg terminal. Click on the balance sheet tab. Very important, you're exporting the standardized data. Don't export the as reported data. Again, output Excel for the balance sheet. Yes. Okay, I don't have any NAs in here. Actually, I do. All right, so Control F. Control F. Thank you. That's why. Copy. Paste special values. Thank you. All right. Now we go Control F. Pound n/a n/a. Replace all those with zeros. File, save as. KO-BS. And the third statement that we're going to need is the cash flow statement because this is going to give us depreciation and cash dividends. So dump it to Excel. Again, we want the standardized GAAP cash flow statement. And yes to the security warning. Once the data is there, select the whole thing. Copy, paste special values, OK. File, save as, Excel, KO-CF. So I now have the three statements. Okay. I'm going to need 3 screenshots. We're going to go ahead and take them now. Next field we're going to use is called DES, which stands for description, security description. It's literally pages of data in summary format that are important for the company, including some industry data about Coca-Cola and their peers and just general information and trends that Bloomberg has added here. But what we're going to care about is on this first page, shares outstanding. So that's the data point that's going to be important for us because we're going to have to get a price per share. We need to know how many shares they have. Here's their current shares outstanding. Easiest place to find it. So again, to take a screenshot, because I don't really need all this data in Excel, then I can also go up here to export. So I click on export, save screen as file, and again, I'll call this my convention is ticker symbol to keep it straight, dash, and then in this case DES, and I'll give you the three or four digit Bloomberg code so that way it's just easy for you to remember. So this is off the description screen. Another thing we're going to need is we're going to need a cost of capital to discount the cash flows to bring them back to present value. Well, we're going to do that based on the WACC, so I need the weighted average cost of capital. WACC gives me a real-time guesstimate of Coca-Cola's weighted average cost of capital. Right? So basically, this is the cost of equity using the CAPM. This is the CAPM. If I don't like the CAPM assumptions, I can change them, but for now, we're going to leave the default. And this is the cost of debt using the yield to maturity on the debt, the current tax rate, and the current market and weight of debt and equity, which is over here. So again, it calculated a WACC. That's the number that's going to be important to us. That's what we're going to use as our starting value in the valuation. So again, file, save screen as file, KO-WACC. This is current. We're doing a valuation as of today. Right? Finally, we are going to do the earnings estimate, EEO, overview. And this is where the analyst consensus data is on forecast. So these are the analyst forecasts that are following Coke, right? And what we're going to, it defaults to the quarterly view. We're going to switch this to the annualized view. So make sure you switch the periods to the annual. Otherwise, you'll have 1/4 of the year, right? But the reason why we're going to do this is that we're going to have to forecast Coke's sales and profits. Well, why are we better at forecasting than the Wall Street analysts that cover Coke for a living? I don't think we are, not at this point. So why not use those in our valuation? So when we start to forecast in just a few minutes, instead of just creating our own forecast, we're going to actually start with Wall Street's forecast to help us with the forecast that we're going to create. We're going to use the consensus. So I'm going to take a screenshot of the current consensus to help us with that. Save screen as file, KO-EEO. Those are the files that are here, right? With one exception, I think I forgot to, in the balance sheet and the cash flow statement, when I uploaded those earlier, I think I forgot to get rid of the NAs. So just in case, I'm going to re-upload the balance sheet. So I'm going to replace this. And I'm going to re-upload the cash flow statement. I know I did in the income statement earlier. I just don't remember if I did in the cash flow and the balance sheet. So those are the 6 files on Canvas. Right? So here's what we're going to do next. We're then going to go back to our Excel file, and we're going to start building out a forecast of Coca-Cola. So again, we're going to use the Ratios tab to do this. Right? So specifically, we are going to choose an 11-year forecast. And what's funny is I've now said this in the last 3 classes, and still 40% of the people on the final exam miss this question. Right? So, and I've even said that I will ask this question in the final exam, and people still miss it. So it's just, you guys have short-term memories. So that's why I'm not worried about what I tell you now. But basically, here's what's key. This is an arbitrary period of time that we're forecasting for these companies. Right? So how long to forecast is actually a difficult question that's addressed in the book as part of the reading. But the short answer is it really depends. And here's what matters. You want to go into 2 periods when you value a company. You want to have what I call a defined period where you're year-by-year forecasting, and then you're going to have what's called a continuing value period when you proxy the long term using the key value drivers equation, the growing perpetuity formula. So the question is, how many years do you have to go until you get to continuing value, right? And it really depends. And that's actually the answer on the exam. It depends. But what it really depends on is that when you're in continuing value, you want the company to be mature, because then the cash flows are relatively predictable. Where when the company's not mature, the cash flows are much harder to predict, which also means the continuing value formula, which has really 3 numbers in it: cash flow, growth rate, and discount factor, which is going to be like 60 to 70% of a company's value. You want those to be relatively stable when you get to those 3 numbers. Otherwise, the numbers you're putting in, you just have too much range of possibility. It really affects the valuation. So the short answer is that you want to forecast enough years in a valuation so that the company is predictable and therefore mature. So you forecast a maturity. So for example, if I'm forecasting Lockheed Martin, how many years do you think I really need to forecast before I go into continuing value?
5 years.
Yeah, probably, maybe even 3. It doesn't really matter. I don't need that many more years. Because, matter of fact, that's why one of the things I'll do is when I show people the key value drivers equation, I'll often pick a company, and then using the key value drivers equation, I'll show you their PE. And I'll show you how the key value driver equation represents their PE. Do you think I would do that with Twitter? Hell no. That's right. Hell no. Why wouldn't I do it with Twitter? Yeah. How do I put into our key value driver equation an expected profit that's continuing, a expected ROIC that's reasonable, even a cost of capital, and a long-term growth rate? Like, those numbers are just too mushy. And that's the problem, is that figuring out Twitter at this point doesn't make any sense. What if I did McDonald's? That's actually what I've done recently as an example. I've been using McDonald's with some corporate clients. And they're like, wow, this is actually the PE. It's really close. Even Google. I was at Google on Thursday. And I did the same thing with Google. And everybody was like, wow, that's our PE. I was like, exactly. All right, because even Google now is getting much more mature and much more predictable. So it wouldn't matter as much. So here's the point. Your two companies are going to be, what, Pfizer and Merck? They're already pretty mature. So we really don't have to forecast out very far. But what we're going to do is we're going to do 10 years. Right? So we're going to do an arbitrary 10-year period, and then we're going to go into continuing value on year 11. That's the way we're going to set up the model. But we really don't have to. We could probably go 5 years. Right? But it doesn't matter because we're in Excel and we're just copying pasting an extra few years. But what you also want to do, and this is also key, and the reason I do 10 is that if a company is cyclical, we're using a reusable model, you want to forecast the whole cycle. Right? So if I'm doing a chemical industry, and chemicals are usually a 10-year cycle where they have 7 or 8 bad years and 2 good years. And then in the 2 good years, they all build capacity, which sends them into another downward spiral for 7 years. Right? And they've done this for 5 straight decades. Right? It's talking about the definition of insanity. It's doing the same thing over and over again. But here's the point. I don't want to forecast half a cycle, because if I forecast the up part of the cycle and then I go into continuing value, then what ends up happening is that I just overvalue the firm. Same thing, if I just forecast the downward part of a cycle and I stop and I go to continuing value, then I don't have a good forecast because I'm going to undervalue the firm. So I have to have enough of a period to also forecast, even for a mature company, their entire cycle. So I'm going to say arbitrarily, I think a decade is long enough, but maybe it needs to be longer. I don't know. And so that's why you could potentially adjust your model. But for our purposes, I'm picking an arbitrary 11-year period. The first 10 years of defined value, you always do 1 additional year. That additional year is the beginning of the continuing value period, hence 11. Okay? Everybody with me on that? So that's where we're going to start. 2013 is our previous historical year. So I'm going to start forecasting. Very important. Don't hard code anything. Hard coding is bad because we're trying to build a reusable model. So as much as possible, relative references. So here's what I mean by that. Equals on the ratios tab, previous year plus 1, 2014. And I'm going 11 years, copy, paste, to 2024. Right? Those are my years. Now, here's what we're going to do. For 2014, revenue growth rate equals the previous year. As a starting assumption for 2014, we're just going to start with the assumption that whatever ratios we had last year are going to continue. Now, eventually, we will change those. But initially, as a starting assumption in building the model, we're just going to say equals the previous year. I'm also, and you're going to see yellow cells in my model, I'm going to introduce the color concept of yellow, and you can pick any color you want. But the idea is I'm making these cells yellow because I'm highlighting to myself, this is a cell that I can change, as opposed to here's cells that I shouldn't change, because a lot of the other cells are pulling data from the other tabs or their calculated results. And I don't want to go in my model later and accidentally overwrite something that breaks my model. So I can use protection in Excel, where I can protect cells to make them freeze, which is not a bad idea as well. But even when I protect the cells, I want to differentiate in some way. I change these cells, I don't change those cells. So I'm picking yellow as cells that I will change. Right? So that's what we're going to do. We're going to change revenue growth rate. Now, I'm going to make a choice. And by the way, this choice is a different choice than I have made in previous semesters, right? But the choice that I'm going to make is I'm next going to forecast gross profit, yellow. So here's the thing. I have to either forecast cost of revenue or gross profit, right? Because one gets me the other. Because gross profit is revenue minus cost of revenue, or cost of goods sold. Bloomberg calls it cost of revenue. So these are the Bloomberg titles over here on the left. So basically, if I forecast one, it gives me the other. So I have to choose which one I want to forecast. So what I'm going to do is I'm going to choose that we forecast gross profits. I chose differently last semester. So this is a completely different model than last semester. So therefore, I solve for cost of revenue. What is cost of revenue? Well, it's 100%, these are percentage of sales, 1 minus my gross profit. Sorry, equals 1 minus gross profit. That would be my cost of revenue. Notice that's not a yellow cell because that's not something I'm going to change later. Right? And the reason I'm forecasting gross profit, it's a key number that's going to matter to evaluation. I want to be able to quickly change it. Next, I'm going to forecast EBITDA. That's actually probably the most important forecast that we make in the model. So I'm going to directly forecast my EBITDA equals previous year's EBITDA as a starting point. Make that yellow. Well, how do I get to EBITDA? For operating expenses equals gross profit minus EBITDA. That will solve for the operating expenses because gross profit minus operating expenses equals EBITDA. So I'm back solving for my cost of revenue, excluding depreciation, and I'm back solving for my operating expenses, which then leads to depreciation. Equals last year's depreciation. That's a number I could choose to forecast. So I'm going to make that yellow. If I have a different depreciation rate in the future, if I so choose. Next, since I'm forecasting EBITDA and I'm forecasting depreciation, guess what I'm solving for? Operating income, operating profit. Equals EBITDA minus DA equals EBIT, also known as operating income. I'm solving for operating income. Right? Now I could directly forecast operating income, but here's the thing. What I've really decided is we're going to directly forecast EBITDA because that's the number that's going to matter. So basically, since I'm forecasting EBITDA, it doesn't really make sense to forecast operating income. So we're going to forecast EBITDA. And then the DA gives us the operating profit. Just like we're going to forecast gross profit, and that gives us our cost of revenue. So it's solving for the other areas because forecasting them independently doesn't make any sense because these are related numbers. Everybody familiar? Questions? Make sense? All right. Then tax rate. I'm going to use whatever tax rate we had. Actually, take it back. I'm going to use an average tax rate. As a starting tax rate. Because I need a representative tax rate, but I'm going to make that yellow because that's a number I could change. But at least I'll use the last 6 years worth of tax rates as a representative tax rate for the company. All right. No plat. Well, what is no plat? No plat equals my operating income times 1 minus the tax rate. That's just my formula. So I'm going to forecast my no plat based on the operating income forecast and the tax rate that I chose. So that solves for my no plat. Then, finally, equals non-operating gains and losses. Whatever the previous year was, that's something I could choose to do in the future, make it yellow. Those are the core items that we're going to forecast on the income statement. Okay, ones in yellow, the ones that are going to be important for us to change. Questions about what we just did? All right, so here's the deal. We now have the income statement ratios for 2014. What we're next going to do is we're going to go to the income tab, and we're going to start creating for, and I'm going to label this so that if I print this statement later, I'll call this the forecast. Caps lock button here. Forecast. I'm going to start forecasting the income statement. So equals previous year plus 1. Okay, so I have my historical income statements, which are coming from Bloomberg, and I have my forecasted statements. So here's the deal. First item I'm going to forecast is revenue. Well, how did I forecast revenue? Well, my ratios, I have a revenue growth rate. So what I'm going to do is I'm going to apply this revenue growth rate to get this forecast for revenue. So what is the revenue growth rate? It's current year minus previous year divided by previous year. So in this case, what is it going to be for next year? It's going to be last year's revenue times 1 plus the growth rate equals next year's revenue. So that's what I'm going to do. Equals last year's revenue, 2013 revenue, times, left paren, 1 plus the growth rate is off my ratios tab, the 2014 growth rate. So I'm going to go ahead and take the opportunity to format this whole column as the $ accounting to 1 decimal place just to be consistent with everything else. But basically, if they grow a negative 2.4%, that would be their revenue. Now don't do what I'm about to do, but the reason why we're setting this up is that if I go back to ratios and I make this 4%, then over here, that number would show me what the 4% growth would be. That's what we're eventually going to do, but for now, I'll undo this. We're just going to start with a negative 2.4%. We're just going to start with wherever they are as a placeholder. Okay. Now notice I didn't make this yellow because I'm not directly putting in a revenue dollar amounts. It's coming from the ratios tab. It's coming from the percentage change. So that's what I'm saying. I don't want to accidentally overwrite this. I'm not going to make this one yellow. All right. Okay. Next item, cost of revenue, excluding depreciation. So in this case, equals ratios, cost of revenue for 2014 times income, 2014 revenue. So basically, I'd forecasted the cost of revenue as a percentage of revenue. I forecasted the dollar of revenue. I multiply the two together. That gets me my dollars of cost of revenue. Gross profit, well, I solve for that. I can see that over here on the left, equals revenue minus cost of revenue. Operating expenses equals, from my ratios, operating expenses as a percentage of revenue for 2014 times income 2014 revenue. EBITDA equals gross profit minus operating expenses. Right? Now I could have done it a different way. I could have taken EBITDA as a percentage of revenue and then solve for operating expenses. Either way, I'm going to get to the same answer, but that's the point. I'm using what I did in the ratios to get here. Okay. All right, depreciation equals, from the ratios, depreciation as a percentage of revenue times, from my income tab, 2014 revenue. Operating income equals EBITDA minus depreciation. There's my operating income or profit forecast. So we very quickly forecasted the operating income of the firm. To be honest with you, in the valuation, we could technically stop here because we have enough information to calculate our NOPLATs and therefore our free cash flows. However, when we forecast, people want to see clean statements forecasted. So I'm going to show you how to get clean income statement and balance sheet forecasts. So we're going to finish up the income statement. Now, interest expense. An assumption of enterprise DCF is that capital structure doesn't change. If the capital structure doesn't change, then we really shouldn't change how much debt the company has. Therefore, whatever debt they have, they're going to have. Whatever interest they pay, they're going to pay. So as a simplifying assumption, we're just going to say interest expense equals the previous year. It is irrelevant to our valuation. This is really just for window dressing anyways. So that's why it's an easy assumption. Why is it irrelevant to our valuation? The forecast for interest expense.
It's just going to investors, right?
Yeah, it's just going to investors. What really matters?
How much is going to investors?
The enterprise value. And the enterprise value is before the interest expense is calculated. So that's the point. We're going to forecast the enterprise value, which is the free cash flow value, which is the operating value, plus the non-operating value, and interest is not part of that. That's why I said this is almost like window dressing. Now, eventually it has to balance, so it's important in window dressing, but nonetheless, we're just going to leave the interest expense here because it doesn't really matter too much to our valuation. Foreign exchange gains and losses. Too hard to forecast, so we're not. Zero. We're going to assume companies can hedge effectively so that they don't really have any gains or losses over time in FX. If you want to do something differently, you can put in a foreign exchange gain or loss forecast. You'll quickly find out it has no impact on the valuation. Third, non-operating gains and losses. Again, we have a forecast for that. So equals from our ratios, non-operating gains and losses as a percentage of revenue times income tab 2014 revenue. Pre-tax income, I can see over here on the left, equals operating income minus the three items below. Minus interest, minus FX, minus non-operating losses and gains. Income tax expense equals the pre-tax income times, from our ratios, the tax rate that we just forecasted. 2014 forecasted tax rate. That's how much we were estimating to pay in taxes. Income before extraordinary items equals pre-tax income minus taxes. That's our income after tax. Next line item, extraordinary loss, net of tax. Here's the key word, extraordinary. What does extraordinary mean? Shouldn't happen again. So should we forecast an extraordinary loss? No, zero. I'm not saying the companies don't have them, but technically if it's really extraordinary, it shouldn't happen again. So we're going to put that at zero. All right, minority interests. These are the payments to the minority shareholders. Same idea. We're not going to change the capital structure. We're not going to change the minority interest. And since it's too hard to figure out what these minority investments are actually going to make, we're going to assume that whatever profits they make, they keep making. They keep paying those profits to the minority shareholders. Equals previous year. If we had more insight into this, we would forecast it. But for now, we don't have more insight into it, so we're not going to forecast it. We're just going to say stays the same. That gets us net income. Equals income before extraordinary items minus the extraordinary loss minus the payment to the minorities. Net income. Now here's the deal. if there are things in the model that we're just putting as a placeholder that we're not forecasting and you feel that it's important to forecast, you can always forecast it, right? But I'm saying it generally doesn't have too much of an impact on the model, and I'm actually giving you the 95-5 rule. These are the 5% that matter. The other 95 are noise in your valuation. Okay? All right. Total cash preferred dividends equal the previous year. Since we're leaving the cap structure alone, if you have dividends, you're going to keep paying them. You have preferred stock, it's going to stay out there. Other adjustments, 0. Other adjustments are literally that. They're accounting adjustments to equity. We're going to not forecast those. We're going to assume that we're going to leave the equity alone. So therefore, 0. No AOCI adjustments here. Net income available to common shareholders equals net income minus cash dividends minus other adjustments. Abnormal gains and losses, 0. These are one-time gains and losses. It's ironic that Coke has had an abnormal gain or loss for 6 consecutive years, but theoretically, they shouldn't, right? But they do. So because they're abnormal, it's hard to forecast them. So therefore, we're not going to. We're going to assume, just like extraordinary items, that these are the one-time events, even though they're one-time events, needs to be occurring every year. What we'll also find is it doesn't affect the valuation. So that's why it doesn't matter. That's why on Wall Street, the analysts ignore one-time items because we assume they're not recurring. This is the game, by the way, that companies play, though. What they'll do is they'll put their operating expenses as one-time items. And then, as the analyst, you actually have to say, are they just gaming the system? Because you could argue that Coke is gaming the system because these are often ignored. But when you start to see them every single year, you start questioning whether or not they're just manipulating their books, right? And that's what I would worry about with Coke, because Coke is, and I'm just saying, it's not, and I'll be very clear because this is going to show up on YouTube, I'm not saying that I believe Coke is committing fraud, right? Don't sue me, please, Coca-Cola. But here's the point, is that one red flag you look out for companies, and this is where companies get into trouble, is that they will put some expenses as one time because it makes their numbers look better, right? So I'm just saying, when you see one-time expenses every single year, you start saying, why are they every single year? Because that's the whole point of operating expenses, are recurring expenses. So if they're really abnormal, you should start maybe considering classifying them as normal. So it just becomes a little bit of a red flag. But in our valuation model, we're going to treat it more straight. We're going to assume everything is proper and abnormal items shouldn't occur. Yes?
Is this like a cookie jar thing where they're pulling something out so they can, because it seems
That's,
very
as we said, that's what you start to ask questions with, which is, are they doing reserve accounting adjustments that are almost like cookie jar accounting? You know, and not saying that they are, because again, this is going to be on YouTube, but I'm saying this is a red flag that we do look for with companies that, again, a lot of people gloss over because they know that we're going to ignore the one-time items, and they can, and they know the earnings estimates matter. So suddenly, hey, we've already exceeded the earnings estimates, and what we're going to do is we'll do an adjustment to the balance sheet to take a reserve to make it a little bit bigger. And it's, we'll be more robust with our reserves. And then next year, when we need the earnings, we'll be a little less robust with our reserves. We'll release our reserves. We'll make it more profitable. Not saying they're doing that, but this is also a company that's been buying back a huge amount of shares as their operating performance has decreased to increase their earnings per share. So I'm not saying they're doing this, but it involves more scrutiny because there are more questions that are now coming up here.
because they had $11 billion in net income in 10, and it seemed like that was the year they had their abnormal losses.
It is interesting that's a good observation. That's an interesting point. So as I said, for valuation purposes, though, shouldn't matter to our value. So I'm going to put that as 0. Because the other part is we don't have, through Bloomberg, true visibility at this point with what these abnormal losses are. We'd have to go actually read the 10Ks. We'd have to go figure this out. And we should, if we're really doing this professionally, because we need to know what these abnormal losses are. And maybe we'll be comfortable with what we see. We just don't know. But as we build the model, we're going to assume that they really are abnormal and the accountants are doing their jobs. Okay. Next, so I'm going to call that 0. So that gives me normalized income, which equals basically the net income plus the abnormal gains and losses, so plus the 0. And then dividends paid. This is just a Bloomberg weird thing, but we're getting the data from the cash flow statement. And on the cash flow statement, whatever dividends they paid, we're going to assume they're going to keep paying. But here's the thing. I know it says normalized income minus dividends paid, but basically the number that's coming from the GAAP cash flow statement for dividends is a negative number. So what we have to do, if we subtract a negative number, it's going to be like adding it. So what we have to do is say equals normalized income plus dividends paid. See, this is minus because the number that's coming through is minus. We have to kind of apply some common sense here and be careful of that. As a matter of fact, I think if I remember correctly, cash preferred dividends, which is G19, which is coming from the IS, on the income statement, we're using the cash preferred dividends, and I'm actually getting from the cash flow statement, I'm getting the cash common dividends. And the reason why is because even though it's down here in the reference item section as a positive number, the reference item section is not consistent, meaning it's not always in the same row. And that causes a real problem in our model. And so therefore, that's why I'm pulling it off of the cash flow statement, because up here, it will always be on row 30. But here, it's a negative number. And that's why. So in the income statement, where dividends are actually showing up in the non-reference item section up here, the cash dividends, they're showing up as a positive number, right? But here, because I'm pulling it for the cash flow statement, the convention is in the cash flow statement is pulling it as a negative number. So just want you to understand why it gets a little inconsistent, but that's why you have to also look at your data source when you're getting these imports in. Does that make sense? All right, so back to this. We have our ratios for the income statement. We have our forecasted income statement. Now it's just copying and pasting. I take my income statement ratios, I copy it, and I go through, paste, 2024. I come to my income tab, I take 2014, I copy column H, and I go to column, I think it was R, which is 2024. These symbols means there's not enough column space, so I select all the columns, move it a little bit to make it bigger. But what I now have quickly done is I have forecasted the income statement through 2024. So very quickly, we've created that 11-year forecast based on these ratios. So if Coke keeps shrinking 2.4% a year, then by 2024 they would only have $36 billion of revenue. That's highly unlikely to happen. So I'm not saying this is the forecast that we're going to live with. We'll eventually change it, but we're just setting up the model right now. Questions? Okay, balance sheet. Go back to my ratios. I now want to forecast my balance sheet ratios. Here's the thing about the balance sheet. These ratios are percentage of revenue. Now, the book talks about how on the balance sheet, you want to forecast everything to be based on the income statement driver. So for example, you want to forecast accounts receivable relative to sales but you want to forecast accounts payable relative to cost of goods sold. Right? So it basically says find the right drivers between the income statement and the balance sheet. Now, that is correct, and that's the way that it is normally done. However, it won't really make much of a difference in our valuation model if we do everything as a percentage of sales. So for purposes of the forecast, making everything as a percentage of sales is a shortcut. It's one we're going to take, and it makes our lives a little bit easier rather than doing it every item, driving by every item. Because you don't get a better forecast given what we're trying to do. And there is one advantage to doing everything as a percentage of sales. If we do everything as a percentage of sales, when the sales grow, so does the balance sheet. So it means that we are essentially forecasting the balance sheet by tying the balance sheet to revenue, which really means we're putting an implied productivity assumption on the operating capital of the business. Or another way of saying that, constant cycle time. So by tying the operating items of the balance sheet to the income statement, we're getting constant cycle time with these balance sheet items. So as revenue grows, gross investment grows. As revenue shrinks, gross investment shrinks. So essentially, it stays constant productivity. But here's the thing, they're percentages. So if we don't like the productivity, we can go back and we can adjust these ratios later, but at least it allows for the balance sheet to grow as the company grows and then helps us with the gross investment forecast that we're going to be doing on the free cash flow. Okay, so here's the thing. For my initial forecast, equal the previous year, make it yellow, copy, paste it all the way down. So I'm just going to do equals the previous year percentages for all of these. So these are the 9 balance sheet items that we're going to forecast. I didn't forecast every item as a percentage of sales. These are what I consider to be the more important ones, the operating ones. Okay. So specifically, come here to my balance sheet. Same thing I did in the income statement tab. I label my forecast period equals previous year plus 1. And now I start forecasting out my balance sheet. And just so you can see it, I'm going to hide the some historical years just so I can quickly jump to 2014. See it all on one page. So, go back to my ratios tab. The first ratio is accounts receivable. So on the balance sheet, I go to accounts receivable for 2014 equals, from the ratios tab, accounts receivable as a percentage of sales, times, from the income tab, 2014 revenue. And then I'm going to take all of these balance sheet items and I'm going to format them currency 1 decimal place. So basically, that percentage of revenue times revenue would give me that forecast for accounts receivable. Next, inventory. So on the balance sheet, equals ratios, inventory as a percentage of revenue times income tab 2014 revenue. Other current assets, ratios 2014 other current assets times income 2014 revenue. Next, long-term investments equals ratios, long-term investments as a percentage of revenue times, from the income tab, 2014 revenue. Net fixed assets equals ratios, 2014 net fixed assets times income, 2014 revenue. Goodwill equals ratios 2014, actually no, sorry, I didn't do goodwill, other long-term assets equals ratios other long-term assets times income 2014 revenue. Then we have, what's next? Accounts payable. So on the balance sheet, accounts payable as a ratio as a percentage of revenue times income tab 2014 revenue. Other short-term liabilities, other current liabilities equals ratios, other short-term liabilities times income 2014 revenue. And finally, I had other long-term liabilities. So for the balance sheet, other long-term liabilities is a percentage of revenue times income 2014 revenue. So basically we forecasted those 9 items off the balance sheet. Believe it or not, we're actually 6 minutes from being done. Almost there. Here's what we have to do first. We have to finish forecasting the balance sheet. And we have to get the balance sheet to balance. And we can't have a circular reference. If we have a circular reference, we have a flawed model. If the balance sheet doesn't balance, we have a flawed model. So what I'm going to show you how to balance the balance sheet without a circular reference. And this is what's important. So the way we're going to do it is we're going to start with the liabilities and equity. And specifically, I'm going to finish off the equity here. So in this case, preferred equity equals previous year. Because we're not changing the capital structure, so whatever preferred stock we have, we're going to keep in 2014. Minority interest equals previous year. Since we're not going to change the capital structure, whatever minority interest that we owe to our current minority shareholders, we're going to still owe them in the future. Share capital and APIC, additional paid-in capital, equals the previous year. We're not going to issue any new common stock because we're not changing our capital structure. So whatever existing common stock at par value we have, we're going to continue to have. The only thing that's going to change in the equity is retained earnings. Retained earnings is basically profit minus dividends. So retained earnings in the balance sheet equals previous year's retained earnings plus, go to the income tab, 2014 change in retained earnings. Cell H25. Because profit after dividends is how much our retained earnings should change if we don't do any AOCI adjustments. We're not doing any of those. So that's the change in retained earnings. That's how much retained earnings, sorry, got to hit the cell. That's how much retained earnings should go up. So again, equals profit plus, or last year's retained earnings plus change in retained earnings, 2014. Why is it not selecting that cell? Plus income, do this again. There we go. Little mouse problem here. All right, total equity, sum of those 4 things. 37,119.7. So we've quickly forecasted the equity. Now we're going to forecast the liabilities. Working our way down. Short-term borrowings is short-term debt. It's interest-bearing debt. Interest-bearing debt, we're not changing the capital structure on. We're going to keep whatever debt we have. Short-term borrowings equal the previous year. Current liabilities, sum those 3 items up. Long-term borrowings, that's long-term interest-bearing debt, equals the previous year. We're again not going to change the capital structure, so we're going to leave long-term borrowings the same. Pension liabilities, whatever we owe to our employees, we're still going to owe. We're not going to let our pensions grow. Under U.S. accounting laws, companies cannot have long-term pension deficits. Therefore, we're going to assume that all pensions are NPV 0. So you owe what you owe now, but you're not going to let it grow, that liability, over time. So we're going to leave it equal the previous year. Again, we can always change these assumptions if we disagree with them. That's the starting assumption that I'm going to make. So long-term liabilities, I sum up those 3 things above. The long-term borrowings, the other long-term liabilities, and the pension. total liabilities equals the long-term liabilities plus the current liabilities. Total liabilities plus equity equals equity plus total liabilities. There's the liabilities and equity that we're forecasting for Coke. We forecasted that side of the balance sheet. Now here's how we're going to forecast the assets, and here's how we're going to get our balance sheet to balance. For total assets equals total liabilities and equity. So that's how we're going to get our balance sheet to balance. We're going to force it to balance. Now, that also infers that we're going to need what in Excel world is called a plug. We're going to need to have one item on the asset side that we solve for to make the balance sheet balance. The plug is going to be excess cash. That's what we're going to solve for on the balance sheet. Everything else leads us to excess cash. Next, we need something called operating cash. We need an assumption for operating cash. So the other tab in the model that I loosely referred to is called the Assumptions tab. And here's the key with the Assumptions tab. With the Assumptions tab, these are miscellaneous assumptions that we will make that we're going to aggregate in one place. So we don't want our assumptions scattered throughout our model. If our assumptions are scattered throughout our model, it'll be hard to remember everywhere we have to go to change things. And when we change companies and reuse the model, it'll make it very difficult for us to remember to go change everything in the appropriate way to make sure we didn't miss anything. So you want to limit, best practice, the amount of changes you make to as few places as possible. For our purposes, the ratios and the assumptions tab. The ratios are the ratios we change. All the other assumptions we change, I'm going to put on the assumptions tab. Just so they're all in one place. Well, one of the assumptions we're going to make is operating cash as a percentage of revenue. We're going to use, they talked about 3 methods in the book. We're going to pick one of them, which is the percentage of revenue rule, in this case 2%. 2% of revenue is 1 week of cash. So we're going to say that is the minimum amount of operating cash. For Coke, could the number be higher? Sure. For our purpose, we're going to start it at 2% for all companies. Okay, we can always adjust it later. That's why it's an assumption. But I'm going to start out with 2% of revenue, and that's why it's going to be yellow. Except here's the thing. We're not going to vary this assumption year by year. That's why I didn't make it a ratio. The point of the ratios tab is every year it can be different. The point of the assumptions is it's always going to be this number. That's why it's on the assumptions tab. So in this case, what I'm going to do is I'm going to come back here to my balance sheet. And for operating cash, what I'm going to do is I'm going to say equals, from my assumptions tab, operating cash as a percentage of revenue, times income 2014 revenue. That's my operating cash balance. Except, here's the other edit I need to make. On the assumptions, I need to put a $ in front of my B and a $ in front of my 3, or what's called a string, because I need to make it what's called an absolute reference in Excel. Because when I copy and paste it, I always want to refer to cell B3. So in order to make it an absolute reference, I put a $ in front of the B, $ in front of the 3. Always when I copy and paste, refer to that cell. I'm solving for excess cash, so I skip that one. Gross fixed assets. Here's the thing about gross fixed assets and accumulated depreciation. We're already forecasting net fixed assets. So the forecast for gross fixed assets does not matter. And the forecast for accumulated depreciation does not matter because we're forecasting net fixed assets. So therefore, we don't really need it. Okay? So we could forecast it, and then we'd have to forecast one or the other. For forecast gross, we have to forecast accumulated depreciation. But I'm just saying it's kind of like a redundant forecast that doesn't really matter because what we care about is the net, and we're directly forecasting the net as a percentage of revenue. So I'm skipping those two. So the last item is goodwill, equals the previous year. Now here's the reason why. Number one, we're not forecasting acquisitions because we don't know what acquisitions the company's going to make in the future. So how do you forecast them? You can't. Number two, goodwill itself is no longer tax deductible, and it only faces an impairment test, which means theoretically it could stay on the balance sheet forever. So that's what we're going to do. We're going to assume that the goodwill is not impaired. Even if it were, it doesn't affect cash flow, and we could care less about it. So therefore, equals the previous year's goodwill. Okay? So that's what we have here. So now we're ready to finish up our balance sheet. Excess cash equals total assets minus everything else. So total assets minus operating cash minus accounts receivable minus inventory minus other current assets minus long-term investments minus net fixed assets minus net goodwill minus other long-term assets. Assuming we did that and we don't get a circular reference, we forecasted a correct balance sheet. Yes.
What do you have for total assets?
93,304.
Right,
That just equals the liabilities and
Oh,
equity.
you just said it.
I just set them equal to each other. So total current assets, I can now do a sum of the items above. Total long-term assets, I can sum from long-term investments all the way down. And just as a check, if I add my long-term assets plus my current assets, I should get the same answer as the total assets. Just make sure my balance sheet balances. But that's the point. I've now got a balanced balance sheet.
Even though we didn't fill in for gross fixed assets.
We're skipping that because we have the net. So the gross doesn't matter. So we're just, I mean, you can put in a gross if you want, but it doesn't matter. Because what we're doing is, even in the ratios, what we're doing in the ratios is we're forecasting the net fixed assets. We're not forecasting the gross. Now we could change the forecast and we could forecast the gross, subtract depreciation to get a net. It's just a little bit easier. Okay. So back to this. Here's the deal. I'm going to take these balance sheet ratios for 2014. I'm going to copy and paste them out to 2024. And then I'm going to go back to my balance sheet, and I'm going to take 2014, and now I'm going to copy this out and paste it out to 2024. And I'll take my columns and make them a little bit wider. And what I should have is balancing balance sheets all the way to 2024. So very quickly, what we've done is we've created a forecast for Koch's income statement and balance sheet through 2024 using the ratios.
What tab are you on the income tab?
I'm in the balance sheet tab now. And you should get 114,633.9 if you're following along. Right? So, beauty of relative references. I go to my economic statement of TII. This is the forecasted income statement. I take column 2013, I copy it, and I paste it out to 2024. And then I have to change the years, relative year equal previous year plus 1. But when I do so, I now have forecasted TII, which balances through 2024 because it's coming from the forecasted income statements. I then go to TFI, do the same thing. I take the 2013 TFI, I copy and paste it out to column R. Years equals previous year plus 1. I now have forecasted TFI going through 2024, that balances. I go to CFI, assuming you didn't do what I did, and if you didn't unhide the columns, or if you did hide them, unhide the columns, total out there. So here's what I'm going to do, take 2013 in column G, copy it to H to R, and I now have forecasted CFIs going out to 2024 that coincidentally balance. I then go to the Economic Profit BOY tab. 2013, copy it, move it out to column R, paste, equal previous year plus 1, copy, paste. I now have, actually column Q, one less column in that one. I now have economic profit based on beginning of year going out to 2024, and go to my EPEOY tab, copy 2013 out to 2024, and I now have economic profit forecasted out to 2024. That balances as well, which is very important. One last step on my assumptions tab or ratios tab, tax rate. I had made the tax rate an average tax rate of the last 6 years, but when I copy and pasted it, I'm still getting an average tax rate of the last 6 years, so it kind of changes every year. I don't really want to do that. So what I'm going to do in 2015 is I'm going to make my 2015 tax rate equal my 2014 tax rate. Because it's not going to, I don't always want it to be a rolling 6-year average. I want it to just be whatever rate I say it's going to be going forward. So then 2015, I'll copy and paste out to 2024. File, save as. So I went to the 2015 tax rate on the ratios tab, and I just set it equal to the 2014 tax rate. Because when we copy and pasted it, we copied that average of the 6 years, so it's always averaging 6 years. And I didn't really want to do that, so I only wanted to average the 6 years in 2014. For 2015, equal the previous year, and then I copied it all the way out. So assuming you do that, on your CFI, you should get in 2024 a CFI of 5370.7. If you have done that, you have completed your homework assignment for this week. This is where we're going to stop. Okay? So what we're going to do is, I told you I'd end class a couple hours early to give you time to start working on the midterm. So we're going to basically do the midterm, but we're going to pick up right here next week. And what we're going to do is, we're almost finished with the valuation model, because the only thing that we're missing, because we now have the forecast of all the cash flows, is to actually present value these cash flows and turn it into the DCF valuation. And we have the forecast of the economic profits, so we present value the economic profits, and we do an economic profit valuation. So we are almost finished with the valuation in terms of the structure of the model, and then we do the what ifs to actually figure out what a fair value of Coke is, but that's what next week's class is going to all be about. Once we finish the model next week for Coke, we'll then very quickly pick another company, download the data, overwrite the data, and then we can value another company. So that's what next week is going to be about. It's about practicing the valuation, finishing the model, practicing the valuation, understanding the valuation process, right? But before we do that, we got a midterm exam to complete. So hopefully you did this. If you do, you can upload. I'm going to change the upload in just a second, so you can upload homework 4, and you're done today. If not, I'm going to post this as a video, post this video regardless, so you have this reference, so you can see this on a go-forward basis. But before I do, I just want to ask one quick conceptual question. Starting in 2024 and looking backwards, notice the CFI between 2014 and 2024 does not change. It's identical. Yet in the previous years, it was all over the place. Why? This would have been a great midterm question. I did not ask it on the midterm, but it would have been a great midterm question. Why doesn't it change?
Your excess cash is flawed, so you always maintain the same level of cash available to investors. And everything else is tied to revenue changes.
Yes, so the excess cash is the plug, so it's the excess cash that's changing. So you're getting to it you're getting into it sort of backing into it. But let's think about it on a forward basis. What is CFI? Cash flow available to investors. And CFI has a balance on both sides of the statement, right? Okay. What did we just say as we were building the balance sheet about the debt and the equity? We're not going to change the capital structure. Did we increase or decrease any debt? Did we increase or decrease any interest payments? Did we buy back stock or issue new stock? So therefore, is the CFI changing? No. So that's why the CFI is constant. Because we're not changing the payout that the company's making. We're leaving it identical. We're not adding or subtracting any new cash. So therefore, when the company generates cash, where's it going to show up? If excess cash is the plug, that's where all the cash is going to show up. So really, what does the excess cash on the balance sheet really represent? It's the potential payout. Now, how you choose to distribute it, these $58 billion by 2024, is up to you. You can pay it to the debt holders, you can pay it to the equity holders, you can pay a dividend, you can buy back stock. It could be any one of those. So that's the point, is excess cash is the money that could potentially be paid out. We don't know how the company will choose to pay out. Let's assume they'll do it in the most tax efficient way, but nonetheless, we know how much can absolutely be paid out. That's why excess cash not only is a plug, but that's why excess cash is really a critical number for a company, because the value of the company is the free cash flow. And then the question is, do I pay it out? CFI. Do I not pay it out? Excess cash increases. So when Apple has $170 billion of excess cash, that's the same idea. What they've been doing is their CFI has been zero for a number of years where they didn't pay dividends or interest. Now that they're starting to pay some dividends and stock buybacks, and they actually have some interest, they have some CFI, but their cash flow is still growing faster than they're paying out, because right now they're still making a lot of money on their products. And that's what we could actually see is happening with Coke as well. Is even with Coke, assuming that they're not doing what? What was the thing that we talked about at the very beginning of the morning, long time ago, with Coke that was hurting their CFI? And acquisitions. So assuming they did a bunch of acquisitions, and think about the other side, what were they doing here? Remember all this share repurchase? And remember they were borrowing debt to do the share repurchase? Well, we're not doing that anymore. But theoretically, we could do some share repurchase, because even with the dividends, their excess cash balance is going up, so that's how much they could theoretically pay out over time. So that's the other just conceptual thing that's happening on the model here that I wanted you to understand, right, before we get into the valuation. We'll again talk about this next week, but that's what you're actually seeing in the statement of CFI, the way that it is structured. Right? But what we've just done today, and we've actually accomplished a lot, believe it or not, in a relatively short period of time, is we've set out a reusable forecasting model that forecasts financial statements to get us forecasted economic statements. And it's dynamic so that we can quickly change it to do what ifs, and we can upload new data to replace what's in here, so we can do this on any company. As I said, if you guys actually had the Bloomberg terminals on your laptops, then what we could do is we could then go back further and just say, for this income statement, make it all based on changing this ticker symbol, and then the whole model immediately updates. But unfortunately, school doesn't have enough money to do that. Okay. So that's where we are. I'm going to call this part 1. I'm not going to upload it because it is a homework assignment. I'll give it to you next Saturday when we get started. But we'll start at this point next Saturday with the rest of the valuation model. So this is where we'll pick up. So I'm going to end the video here.